Let's start with the tax loops that are just clever. We will work our way towards the ones that feel illegal. Number 9 is the buy, borrow, die cycle. This is the single most important concept in modern wealth accumulation. Most people think billionaires have a vault full of cash. That is completely wrong and mathematically impossible. Cash is a liability because inflation eats it alive. So the ultra wealthy keep all their money in assets like stock. But here is the problem with owning stock. You cannot buy a super yacht with Amazon shares. You have to sell the shares to get the cash. And the second you sell that share, you trigger a taxable event. The IRS immediately wants 20% for capital gains. That is a massive loss of wealth just to pay the bills. So the rich figured out a simple workaround. They go to the bank and pledge their portfolio as collateral. The bank gives them a massive line of credit. The interest rate on this debt is usually extremely low. It is often under 3 or 4%. Paying 3% interest is cheaper than paying 20% tax. And here is the kicker regarding that debt. Loan proceeds are not considered income by the IRS, so you can borrow $10 million to live on. And your taxable income for that year is effectively zero. You spend the loan money on your lifestyle. Your stock portfolio grows faster than the interest accumulates. But you might be wondering about the debt itself. When do they actually pay back the principal loan? That is the dark genius of the strategy. They never pay it back while they are alive. They hold the debt until the day they die. When they die, their heirs inherit the stock and the debt. But the tax basis of the stock gets reset. This is called the step-up in basis rule. The capital gains tax liability vanishes into thin air. The heirs sell a little stock to pay off the loan, and the rest of the fortune is theirs tax-free. Number 8 is the Augusta Rule. This sounds like a conspiracy theory, but it is federal law. It is officially known as Internal Revenue Code Section 280A. It allows you to rent your home to your own business. This loophole exists because of the Masters Golf Tournament. Wealthy residents in Augusta, Georgia, wanted to rent their homes. They lobbied Congress to make short-term rentals tax-free, and now every business owner uses it to strip cash. Here is exactly how the strategy works in practice. You have an S-Corp or an LLC that makes money. Your business needs to hold board meetings or strategy sessions. Instead of renting a hotel conference room, you rent your house. Your business writes a check to you personally for the rental fee. That expense is 100% tax deductible for the business. So the business reduces its taxable profit immediately. But on your personal tax return, it is magic. You do not have to report that rental income. As long as you rent it for 14 days or less, it is completely tax-free income in your pocket. Let's look at the math on a nice house. The fair market rent for a luxury home is high. You could justify $2,000 per day for a venue. Multiply that by 14 days a year. That is $28,000 of tax-free cash. You just moved money from your business to your pocket, and the IRS cannot touch a single cent of it. But you must follow the strict documentation rules. You need to take actual minutes during the meeting. You cannot just sit on the couch and watch Netflix. If you get audited, you need to prove the business purpose. But for 14 days a year, your dining room is a tax haven. Number 7 is the G-Wagon Deduction. You see these boxy Mercedes SUVs everywhere in Los Angeles. Every YouTuber and influencer seems to drive one. You might think they just have bad taste in cars, but the Mercedes G-Wagon is actually a rolling tax shield. This exploits Section 179 of the U.S. Tax Code. This law was originally designed to help farmers buy tractors. It lets businesses write off the full cost of heavy equipment. The IRS defines heavy equipment by a specific weight. The vehicle must have a gross vehicle weight rating over 6,000 pounds. A normal sedan or small SUV is too light, but the G-Wagon weighs almost 6,600 pounds. It is technically a heavy truck in the eyes of the law. This unlocks what is called bonus depreciation. If you use the car for business more than 50%, you can write off the entire purchase price in year 1. Let's say you are a high-income real estate agent. You make $300,000 in commissions this year. You would normally owe a massive amount of federal tax. So you go buy a G-Wagon for $200,000. You immediately deduct that entire $200,000 from your income. Now, the IRS thinks you only made $100,000. You just saved roughly $70,000 in taxes. Essentially, the government just paid for a third of your car. This applies to other heavy vehicles as well. The Range Rover and the Cadillac Escalade also qualify. It creates a perverse incentive to buy massive gas guzzlers. Buying a sensible hybrid gives you almost no tax benefit, but buying a military-grade tank is a savvy financial move. This is why luxury car dealerships market specifically to business owners. They are not selling transportation, they are selling tax deductions. Just make sure you actually drive it for work. If you use it for groceries, the IRS will come knocking. Number 6 is the Art Freeport Freeport Stash. This is why modern art sells for $50 million. It has nothing to do with the quality of the painting. It is entirely about moving money across borders unseen. If you buy a Ferrari, you pay a massive sales tax. If you import gold, you pay heavy customs duties. But art is treated differently by international law. The ultra-wealthy use high-security warehouses called Freeports. The most famous one is near the Geneva airport in Switzerland. It is a maximum security bunker that holds billions in art. It is estimated to hold more valuable art than the Louvre Museum. When a billionaire buys a Picasso at auction in New York, they do not hang it in their living room. They ship it directly to the Geneva Freeport. Technically, the painting is in transit indefinitely. Because it has not officially entered Switzerland, it is tax-free. No import duties and no value-added tax are paid. It sits in a climate-controlled crate in the dark. Years later, the billionaire wants to sell it for a profit. He sells it to another billionaire who also uses the Freeport. The money changes hands between offshore bank accounts, but the painting never leaves the warehouse shelf. It just gets a new owner label on the crate. Since the transaction happened in no man's land, there is no tax. It is a shadow economy completely outside of government reach. You can trade assets worth hundreds of millions tax-free, and the painting never even sees the light of day. It is just a poker chip for the global elite. Some paintings have been stored there for decades unseen. It is a tragedy for art lovers, but a miracle for accountants. Number 5 is the golf course easement. This is a favorite strategy of real estate moguls. It relies on a charitable deduction called a conservation easement. The government wants to encourage people to save nature. So if you promise not to destroy a forest, you get a tax break. But the rich have weaponized this good intention. Let's say you buy a plot of land for $10 million. You build a private golf course on it for yourself. Then you hire a friendly appraiser to value the land. The appraiser says, if you built condos here, it would be worth $50 million. You say, oh no, I will save the land for nature. You sign a legal document promising never to build condos. The IRS treats that lost $40 million as a charitable donation. You just created a $40 million tax write-off out of thin air. You spent $10 million, but you deducted $50 million. And the best part is you still own the land. You still get to play golf on your private course. You just promised not to do something you didn't want to do anyway. Investment syndicates actually sell these deals to rich doctors and lawyers. The IRS data shows investors save $2 for every dollar spent. The IRS hates this and is trying to crack down on it. They call them abusive tax shelters in court filings, but as of right now, it is still happening every day. It is the ultimate way to have your cake and eat it too. Number 4 is the 1031 exchange ladder. This is the holy grail of real estate investing. It is named after section 1031 of the tax code. If you sell a stock for a profit, you pay capital gains tax. If you sell crypto for a profit, you pay capital gains tax. But real estate gets a special get out of jail free card. You can sell an apartment building for a massive profit and pay zero tax if you follow one rule. You must use the money to buy a more expensive building. This is called a like-kind exchange. The government lets you defer the tax bill to the future. However, the rules are incredibly strict on the timing. You only have 45 days to find a new property, and you must close the deal within 180 days. If you miss the deadline by one day, you owe millions. So you sell a duplex and buy a fourplex. Then you sell the fourplex and buy an apartment complex. You are snowballing your wealth tax-free for decades. You might think, well, you have to pay the tax eventually. That is where the swap until you drop strategy comes in. You keep doing 1031 exchanges until the day you die. Remember the step-up in basis rule from Fact 9? It applies here too and wipes out all the deferred tax. Your heirs get the massive skyscraper completely tax-free. Decades of capital gains simply vanish from the record. This is why real estate families stay rich for centuries. They never actually cash out, they just trade up. It is a game of musical chairs where the music never stops. Number 3 is the Roth IRA Super Stash. Most people use a Roth IRA to save for retirement. You put in post-tax money and it grows tax-free. There is a strict contribution limit of $7,000. The government expects you to have maybe $1 million. But in 2021, a ProPublica leak revealed a dark secret. Tech mogul Peter Thiel had $5 billion in his. How do you turn thousands into billions inside a wrapper? It starts with a concept called the founder share. When a startup is born, the shares are worthless. They are valued at fractions of a single penny. The founder buys millions of shares for $2,000. He puts these shares directly into his Roth IRA. Technically, he did not exceed the contribution limit. He followed the rules of the game perfectly. Then the startup explodes and goes public on the market. Those shares skyrocket from pennies to hundreds of dollars. Suddenly, the account is worth hundreds of millions. If this money was in a regular brokerage account, first, he would owe massive capital gains taxes upon selling. But the magic of the Roth IRA is the withdrawal. Once you turn 59 and a half years old, you can withdraw everything completely tax-free. That is $5 billion of pure profit. Zero tax paid to the federal government. Congress is furious and trying to close this loophole. They want to cap the size of retirement accounts. But for the early tech giants, the damage is done. They secured a tax-free fortune for life. Number 2 is the Puerto Rico move. Normally, the United States taxes its citizens on global income. You cannot escape the IRS, even if you move to Mars. If you renounce your citizenship, you pay a massive exit tax. It is like a prison membership fee you cannot cancel. But there is a glitch in the matrix called Puerto Rico. Because it is a territory and not a state, it is special. They passed Act 60 to lure wealthy mainlanders to the island. The offer is almost too good to be true. Move your primary home to the island for 6 months. You must prove you are there for 183 days a year. If you do that, your federal income tax drops to 0. Your capital gains tax drops to 0% immediately, and your business corporate tax drops to 4%. Compare that to a high-tax state like California. You would pay over 13% just to the state, plus another 37% to the federal government. By moving to Puerto Rico, you save half your money. You are effectively doubling your income by getting a tan. Crypto billionaires and hedge fund managers are flocking there. They buy mansions in Dorado Beach and trade from their laptops. They keep their American passport and protection, but they pay taxes like they live in the Cayman Islands. It is the ultimate geographic arbitrage for the wealthy. Just make sure you actually stay for the 6 months. The IRS tracks your cell phone data to check. Number 1 is the Dynasty Trust freeze. This is the ultimate weapon against the death tax. Historically wealthy families eventually lost their fortune. The estate tax takes 40% every time someone dies. Over 3 generations, that wipes out most of the money. This was designed to prevent a permanent ruling class, but the state of South Dakota decided to change the game. They abolished a common law called the Rule Against Perpetuities. This rule used to force trusts to dissolve after a century. Now you can create a dynasty trust that lasts forever. Here is how the ultra-rich use this tool. They move their assets into the trust while they are alive. The trust owns the stocks, the real estate, and the gold. The billionaire is just the manager of the trust. When the billionaire dies, the trust does not die. The assets never technically change hands to an heir, so the 40% estate tax is never triggered. The children are simply named as beneficiaries. They get paid dividends from the trust to live on, but the principal pile of gold remains untouched. It grows tax-free for centuries, compounding infinitely. This creates a class of people who never have to work. Their great-great-great-grandchildren will be billionaires. South Dakota now holds over $300 billion in trusts. They have become the Switzerland of the American Midwest. It turns the concept of meritocracy on its head and cements the wealth gap for eternity. So there you have it, the playbook of the elite. The tax code isn't just a list of rules to follow. It is a treasure map for those who can read it. While you stress about saving $10 on groceries, they are saving $10 billion on their legacy. Is this a smart use of the legal system, or is it a moral crime against the working class? Let me know your honest thoughts in the comments below. And if you want to see how they spend this money, click the video on your screen right now. We break down the most expensive objects ever sold. I will see you over there in a few seconds. Thanks for watching, and good luck with your taxes. You are definitely going to need it.